The debate between real estate and stocks has been going on for decades, and both sides have strong arguments depending on goals, risk tolerance, and time horizon. Real estate is often seen as a tangible, long-term asset that can generate rental income, build equity, and benefit from property appreciation, while also providing a sense of stability and leverage opportunities. On the other hand, stocks offer liquidity, diversification, and access to global companies that can grow rapidly and compound wealth over time without the responsibilities of physical ownership. Today we will talk about the investment battle, real estate versus stocks. So before we get started, make sure to hit that like button, also subscribe to my channel. 10. Most investors compare real estate and stocks the wrong way. When people debate real estate versus stocks, the conversation often turns emotional or overly simplified. Some say real estate is always safer. Others say stocks always outperform. But the truth is more nuanced. Both asset classes have created massive wealth over time, but they do it in very different ways. Stocks represent ownership in businesses that can scale globally, while real estate represents ownership of physical property tied to location and scarcity. Instead of asking which one is better, smart investors focus on how each asset behaves under different economic conditions and how they fit into long-term wealth-building strategies. 9. Stocks offer liquidity and global growth exposure. One of the biggest advantages of stocks is liquidity. Investors can buy or sell shares quickly, making it easier to adjust portfolios based on market conditions. Stocks also provide exposure to global economic growth, including technology, healthcare, finance, energy, and innovation-driven industries. As companies expand internationally, stock investors benefit from scalability that physical assets cannot match. This global reach allows stocks to compound wealth across entire industries and economies, making them one of the most powerful long-term growth engines available to ordinary investors. 8. Real estate offers stability and tangible value. Real estate behaves differently because it is a physical asset tied to land and location. Unlike stocks, property cannot disappear overnight due to a market panic. It provides a sense of stability because it has real-world utility. People need places to live, work, and operate businesses. Rental income can also create consistent cash flow, making real estate attractive for investors seeking predictable returns. However, it is less liquid than stocks and requires more capital, management, and maintenance, which makes it a more hands-on investment. 7. Stocks compound through business growth. The power of stocks lies in long-term compounding driven by business expansion. When companies grow revenue, improve efficiency, and reinvest profits, shareholders benefit from increasing value over time. This compounding effect can be extremely powerful over decades, especially in sectors driven by innovation and technological change. Stocks allow investors to own small pieces of companies that may scale into global giants, creating exponential growth potential that is difficult to replicate in physical assets. 6. Real estate compounds through leverage and appreciation. Real estate wealth often grows through a combination of property appreciation, rental income, and leverage. Many investors use borrowed money to acquire property, allowing them to control larger assets with smaller initial capital. Over time, as property values increase and loans are paid down, equity builds steadily. This creates a different form of compounding compared to stocks. Instead of rapid scaling, real estate often builds wealth through structured debt reduction and long-term appreciation. 5. Risk looks different in each market. Risk in stocks is often driven by volatility, market sentiment, and business performance. Prices can fluctuate daily based on news, earnings, and investor emotion. Real estate risk is slower moving, but can be significant during economic downturns, interest rate changes, or local market shifts. While stocks can drop quickly, they can also recover quickly. Real estate tends to move more slowly in both directions. Understanding these different risk profiles helps investors build balanced portfolios instead of relying on a single asset type. 4. Income versus growth trade-off shapes strategy. Real estate often attracts investors looking for steady income through rent, while stocks attract those seeking long-term capital growth and dividend income. This creates a natural trade-off between stability and growth potential. Some investors prioritize cash flow and predictability, while others focus on long-term appreciation and reinvestment. The best strategy often depends on personal goals, time horizon, and risk tolerance, rather than a universal rule about which asset is superior. 3. Economic cycles affect both markets differently. Economic cycles impact stocks and real estate in different ways. Stocks tend to react quickly to changes in interest rates, corporate earnings, and global sentiment. Real estate often responds more slowly, but can be heavily influenced by borrowing costs and local demand. During strong economic growth, both asset classes can perform well. During downturns, both can face pressure, but the timing and intensity of those effects often differ significantly. 2. Diversification often wins over debate. Instead of choosing between real estate and stocks, many experienced investors combine both. Diversification reduces dependence on a single market cycle and spreads risk across different economic drivers. Stocks provide liquidity and growth, while real estate provides stability and tangible value. Together, they create a more balanced portfolio that can perform across different financial environments. This approach reduces emotional decision-making and increases long-term consistency. 1. The real investment battle. Not real estate versus stocks, but time versus emotion. The deeper truth behind the real estate versus stocks debate is that success is not determined by choosing one asset perfectly, but by how consistently an investor stays committed over time without reacting emotionally to market cycles. Because the truth is simple, both asset classes reward patience, discipline, and long-term thinking, and both punish fear-driven decisions. And once you understand that wealth is built more through behavior than asset selection alone, you begin to see that the real battle is not between real estate and stocks. It is between emotional reactions and long-term consistency. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.